Hello and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today's agenda, we'll go through the market update, not too much on earnings, and then Joe's going to go through the some of the ETFs, I believe. So yeah, I'm sorry for the schedule change. Joe and I are traveling the rest of this week, so we had to move it to today to Tuesday. And last week, we had an in-office meeting in Tampa, so we'll get back on the regular schedule here starting next week. So appreciate you guys bearing with us. Okay, let's get started. Okay, so green overall, you can see SPX, Russell are both in 8, NASDAQ 10.5 there. Yeah, we'll do the state analysis on those. As far as the pie, you can see, we had 18, we're at 21, so it looks kind of like it's bottoming here, at least, short term. So big movement since we last talked. We're state 8s at 51%, which is definitely a high level. And we're technically oversold, below 30. And we had talked about that. We had expected to go below, a little below 30. What's that? All right, and to mute him. Okay. So, we expected it to go a bit below 30. So, it did. And it looks like it's starting to pull back up. So let's look at the market pulse. I think, this is the bullish bearish. I think this is the most important thing. So you can see back here, right around 78, March 13th. We almost pretty much like flatlined since then, plus or minus like 2%. That was like the bottom day there. And since then, we've basically been, slowly, we popped up above 80. So that's, typically, if we pull this back a little, I mean, 80 is a pretty good number. Back here at 87, 88, these got higher. This one didn't get up near that high, but that's a pretty high number overall for that 80. And, it just looks like it's kind of, short, I'm saying not long-term view. I'm talking like tactically, looks like it's, could roll over here, the bearish sentiment, and, we can get some movement up. That's what it looks like, when I'm analyzing, this chart here. We had some spikes here on the movement down. Nothing huge, but definitely something. But not one of the monsters that we've seen in the past. So we just have to keep our eye on this, see if if it does quiet down. Obviously, this would be foretelling that we can expect some movement back up on the bullish and bearish. I mean, you can see once we find the bottom here, typically we'll climb back up, so it keeps going up and down, obviously. So looks like it's, found the bottom here, barring any kind of strange events. So obviously, overall bearish for the market. We get the below 200 MAs on the high end here. So as long as that's in effect, it's obviously kind of bearish medium term. So but short term, it does look bullish, and we're starting to get into the earnings season. So we typically get run, some decent, movement up, going into the earnings. We're a couple weeks out from the first real, earnings report. I think here, 13th, 14th, that's the banks start going, and obviously the banks are the big focus right now, right? So overall bullish bearish. So these are still climbing the state 8s. So I'd like to get even more bullish Short term, I'd like to see those like level out at this range here, this 50. You can see back here, we got up pretty high, 60s, 70s. So we're at 50. Back here we got up to 51. So, we're definitely in a range, and you can see the ones are, kind of flat, it's starting to build a little. The sevens are just dead here, we're at 3%. So really you just kind of want to keep your eye on those sevens, see if we start getting an uptick in the sevens. So, because we got so many in 8. So we'd like to see that flatlining and then the sevens start picking up. Then we get, pretty bullish short term. Long term, I'm still a little pessimistic about, the whole state of affairs. So, but short term, I think we can, going into this earnings, I think we can see a little positive movement. Okay, so let's pull up our little tool here. So 3800s are kind of key level here. So that's a 38. This is obviously another kind of bullish sign. It goes into state 8 and pretty much goes nowhere. Typically it'll kind of run down to the first target. So it didn't do that. Let me change the color. Typically we get the rundown here. So this is kind of a bullish sign where it runs up to the stop, kind of does the opposite. It's almost like a bullish move. It runs up to the stop, gets to the resistance, and then kind of moves back up. So definitely not a good 8 signal there, but bullish wise it does look pretty good, especially if we hold this entry price here, this call it 3,900. So as long as we hold that, then I would expect we break this 8 and get back into 7, at least for SPX here. So that's where we're at there. Let me pull up the bigger charts. So we've been talking these levels for a very long time. This is that 3,800, and the top end is our 42. So you can see we've been pretty good. That was that 42, and then down here got close to 38 and just took off. So once again, middle of the range. With earnings coming up and like how steep the market pulse and state aid. I mean, for me, it looks like we're going to get a little, we're going to be going up a little short term. Now, can we break these levels? I don't know. We've been in this range for quite a while. Let me pull out. We've had a few breaks above and below, but generally, kind of going back here, May time frame with a few breaks. But generally, I think we're still kind of range bound. Slight upward bias, short term, and long term, I'm still pretty bearish overall. Just because nothing really has been fixed and things are actually getting worse. Big picture, especially with the bank stuff going on. So that's SPX. Let's go to Russell. Russell also in state 8. So this one's kind of having a fight here, at the entry price. Had a little movement down, but you can see our 1700 level, obviously the key level here. We've been talking that for a long time, 17 to 19. So got down to 17, and just jumped off of that. So you can see here, this was the day we got to 17. Jumped off, next day up. So as far as I'm concerned, that 17 is good for now. And that's kind of where I'm at. So where we want to be we want, to be bullish here. We want to stay above this entry price and, obviously make a run up here. So let's take a look at the longer term chart here. Let's do that one. Okay. There's our 19. Yeah, we had that break, very similar to this August break. And then here's our 17. So, we touched 17, obviously, got below it there. And, basically rocketed up. We're up. This one's been hit harder. I mean, this is the banks, pretty, the banks that have been affected are, smaller in size compared to like, the JP Morgans and stuff that are on S&P 500. So this one, got hit pretty hard this couple days. I mean, it's still very similar to like kind of this action here, that we had, from up here basically down to the 1700 area, where that eventually held, retest held. So 1700 is the key level, really. If that breaks, then, if it breaks and it holds below there, I'd say, watch out. But until then, I still think, we're in this range currently, 17 to 19. I don't know if we have enough to get above here. But it looks, based off of the other charts, all the charts I'm seeing, it looks like we're going to be at least inching up, short term, going into earnings. So, which is kind of a typical pattern for things. Okay.
Hey, Josh.
Yeah.
Great comments there on that. Just from a wave perspective, I think unlike going back in September where we did have, those downward moves, they were pretty much the ABC moves. I mean, if you take a look, from the recent high in early February, you can make some five-wave count here. Basically starting at the top around February 2nd and then making your way down. So, and as you pointed out, that bank news, that was a classic, leg 3 in the middle of March. And I think the question now is, so there, right there could be one, right there is certainly the beginning of 3. Okay. And so right now, it's just a question whether, that last leg down, it's a green candle where we broke 1700, got down to whatever, 1689.
Yeah.
I think the question is that the end of leg 5 or is that basically a leg 5 inside of leg 3? And so, if we break that recent, 1689 low, clearly, we're going to have another leg down. But, it looks like from a wave standpoint where we're starting to at least get to, a bit of an exhaustive range, to the downside. And it's just a question, to see whether we hold or not. So sorry to interrupt.
No, you're always welcome to interrupt. Yeah. I mean, there's just lots of things. I mean, we're oversold. There's a lot of oversold type things, which is kind of makes me, short-term bullish on things. So obviously not long-term. I keep saying that, but I want to pull
it out well.
A couple of things. So this has been big changes here. So where are we at? Okay, so our current target's 40. This is where we're at. 475 to 5. So May is the next meeting. So beginning of May, obviously. So still kind of a coin toss whether they do stuff here. Obviously, that's changed a lot. It was pretty much a quarter, a month ago, and 50 was kind of between those two with more at the quarter. So let's look now what they are saying for December, right? So the current is 475. So they have December, at least, a couple cuts in there as the median. So that'd be, 50 basis points below where we currently are. And that's for December. So they're saying at some point, they're expecting cuts, right? And, I think it keeps moving down after that. So they're expecting cuts sometime later this year. So that's the market consensus. I think that's why you're getting, some support here, and, the market's not tanking, because the expectations have shifted. Let's just look at, this December. So like a month ago, it was pretty much, this was, uh, kind of the range, a little above where because we currently are at 475. So at the end of the year, they were expecting, this was the expectations a month ago. Now, we're way below, like, cuts. And that's just because of, what's going on with the banks. And, that's where the expectations have shifted. I'm not sure, the Fed, what they've said has indicated that, but that's what the market's saying, expecting. I don't think the messaging has changed out of the Fed, so I think there's quite a disconnect. But I think, the market's saying, no, they're going to have to, by the end of the year, start cutting. So that's the expectation, right? And we had a long talk about that, a few meetings ago about, the disconnect previously. So, is this another disconnect? I mean, based off of, the Fed's, doing what they're saying they've done. So if they say no rate cuts this year, that's their plan right now. So, but the market says otherwise. So plan accordingly with that. Another kind of, tailwind for markets is QE. So, we've been watching this on a weekly basis. We're kind of, this is the level that I kind of pointed out. We're, the percentage drop that we saw back here in 19, that's where we started getting into trouble. So we got into trouble here, with the banks, and this is that injection of cash. So pretty much 300 and then another 100 billion. So this level 87, I mean, we're back to where we were, kind of October. So all that works for naught. I'm not sure how long, this is a short-term type thing, but, they said they're going to continue their descent. So, we'll see little minor drops, and, hopefully no more bumps, but, more cash. The QE is, generally net positive for equities, where, the tightening QT is net negative for equities. So obviously big changes there, with the bank failures. While talking about banks, I saw this on Twitter. So it's a paper by New York University. It said U.S. banks had unrealized losses of 1.7 trillion at the end of 2022. That was like 3 months ago. So the losses nearly equal the bank's total equity of 2.1 trillion, according to this university. So what we're talking about here, with like that Silicon Valley, they bought, and we'd talk a lot over time, just like, the 10 years at 1.7, like, who's buying this stuff? It's the banks, it's the pension funds. And most of them seems like aren't even hedged against interest rate risk. So what happened with Silicon Valley Bank, they have all these unrealized losses. People start pulling money, they're worried about it, word gets out, big run on the bank. and they have to end up selling some of these securities, and then, they're done because the losses are enormous on, um, even right now. So like the 10-year, it's at 3.56. So that's double, what a lot of these rates that they got. And a 10-year, or, God, if they're doing like 30 years. um, so, they're 2 years in, and, who's going to want to buy that 1.7 now? I mean, who wanted to buy it back then? Now it's even worse. Like, so the haircuts are taken on these, if they have to sell these, is huge. And, I saw one for like Bank of America, right? So Bank of America, like and there's nowhere that this is like readily available. You have to go into the financial statements and look at their, like a certain section to see, their holdings and, their unrealized losses. Like, so they put all the bad stuff, these long-term treasuries, these long-term mortgage, backed securities, in, hold to maturity, pile. So that's what they're hoping, is that, they can just hold these to maturity, collect that 1.7% each year. And, just, okay, they still made money, but, where, they get into trouble is, deposits, if they have to start, getting cash, that's where they don't want to have to, and that's where banks can fail. If they have to start pulling from there, they're going to realize huge losses. So like the Bank of America in like 2021, their unrealized losses was like 1 billion or something like that. Now it's 100 billion. So at the end of 2022, those are general numbers, not exact, but I saw the spreadsheet, from the, their, their quarterly report. So you can go in there and look and see how bad some of these banks are, and, hopefully they're hedged. So they have, interest rate, contracts, to counter the risk that they've taken. So, banks, pension funds are, I'd say, the biggest. Banks have to buy these type of securities. So like high rated triple B and above. Pension funds are similar. So you haven't heard anything about pension funds, other than the one in England. So that would be, a concern I would have. A lot of these funds, and I mean, to make, things even more dire, I mean, think about the European banks. So like Credit Suisse, they were probably buying like those negative rate ones. The European rates were negative. So, someone was buying them, and it's probably the same culprits, the banks and pension funds. I'd have to look more in depth about, like that pension fund from England, but I'm sure they had some of that garbage. I mean, who's going to buy a bond that you lose money on? And now, the rates are higher. No one's going to touch that with a 10-foot pole. And the losses on that, if they have to get rid of it, or would be astronomical. No, I'd be surprised if there was a bid on any of those, in the secondary market. Yeah.
Hey, Josh.
Yeah.
Dan here.
Mhm.
Looking at the graph there you have on the page here.
Yeah.
That spike going up on the right-hand side of the chart shows the money that was infused back into the banking system. And
Yeah, well, I mean, they acquired, so this is like, the assets that the Fed acquired.
yeah,
So, but it's I don't know, I didn't break down the specific, what came in, but I'm sure it's, they took on stuff from these
yeah.
failed banks.
What they're technically what they're saying is that it doesn't really affect them selling off their assets because that's a loan. Okay, I think what they're doing is they're giving the banks time to allow those low interest notes to mature so they can get their money back. Okay, but they have to pay this back. Okay, but at the same time, they're to do that, they have to tighten credit. So loans are going to be very hard to get a loan out of the bank unless you have some really good asset as collateral, but they're doing basically the work of the Fed. So it has the same effect as the Fed increasing the interest rates, percentage, net percent amount, 0.5%, 1/4%, whatever, because it's doing the same thing. They want to stop people from spending, and this has the same effect because people aren't going to be able to go out and get loans for new cars, houses, and things like that, because the banks are
Scared.
but it's a catch-22 because if for every incremental point that the Fed increases the rate, that means it's tightening up on these banks even more as far as lending, because they have to hold those and secure until they expire, and some of those are probably long-term notes.
Yeah, I mean, there's some that they're just stuck with them, the whole, I think they're just being optimistic with, the view. It's like, well, they're gonna have to cut rates so the banks don't fail.
Yeah. And if they cut the rates, then your inflation's going to take off. So
Yeah.
they're stuck between a rock and a hard place right now. So
Right. Yeah. I mean, I was optimistic, generally that, okay, the money, M2 is kind of the key thing. So they were shrinking the money supply, which would help the inflation. I think they, the rates, I think they needed to go, around 3. They definitely didn't need, they don't need to go this high. They wanted to slow the craziness and the real estate market and stuff like that, and, where the rate is right now, that 3.5, it kind, this 10-year always just kind of comes back to 3.5. It gets below, kind of pops up. That's kind of like the magnet, as Joe said, 3.5. I mean, that's a fine level. I don't think they need to, try and get it much worse, but really it's the M2 was the key, so they're pulling money out of the economy. So that was the only thing I would say, made me slightly optimistic, but I mean, now, less so. No, but we'll have to keep an eye on the M2 and, with this big jump up, see how much made into the money supply. And I mean, God knows what's going on back here. So, and, just watch the other banks. So if the other banks, I'm sure there's lots and lots of them that are unhedged, that are in similar, I mean, that's what this whole little, research was about. They're in trouble, right? So this whole optimistic view, I don't know. I mean,
it's a huge headwind, the whole banking system right now. I don't know if you've had an opportunity to see Senator Kennedy when he was grilling Janet Yellen on the Senate floor.
no.
Oh, YouTube it.
Yeah.
It's just mind-boggling how inept she is. I mean, it was like talking to somebody that was senile. She could not answer the questions. She was confused by the questioning on basic stuff, and she denied her responsibility in most of the stuff, But if you got the time, YouTube it. It's a recent when she appeared in front of the Senate.
Yeah, I'll take a look.
Worth taking a look at. It'll scare you.
Yeah. So, well, I think that was it. Still like keeping our eye on the Dow Internet Head and Shoulders. Yeah, that's kind of one and I've been watching Schwab too, trying to get some more information. And that's obviously a huge one that you want to keep your eye on. If they get into trouble. But yeah, this Head and Shoulder, you can see it here. So I'm just saying if it, just seeing if it'll pop up above kind of those levels. Otherwise, it's still in that range. This was like a year and a half, I think, this shoulder, had that huge pop up. So I'm just watching this kind of level to see if it, gets above there. Otherwise, it's still in the zone where, things can get ugly on those type of those charts. All right. Obviously, M2 also is a big thing. I'm still trying to find a good chart for that. So, all right, I'll open up. Thanks, Dan. Any other questions or comments? Don't be shy. We got a small crowd for Tuesday, so.
So Josh, Lee here.
Yeah. Hey, Lee.
Hey, coming into a presidential election in about a year and a half, roughly. And I don't think whatever party is in the White House, I don't think they want to have a failing economy when the election's going on.
Right.
Now, that's just me. And in my opinion, I think Powell and Janet Yellen are under enormous pressure. And you can say whatever, anybody can say whatever, but that's just my opinion.
Mm-hmm.
I really have trouble wading through the water and thinking, okay, how will they let it go? Because I agree. If things start getting difficult, the Fed will loosen rates or lower rates, let me say, and the stock market will take off in theory. But then you've got inflation jumping high,
Right.
just like Dan just said. So, do you have any thoughts on that? You or Joe or Dan or
Yeah, I
Anybody
mean,
else?
obviously,
Yeah, Lee,
go ahead.
Lee, I wouldn't, personally, I wouldn't feel too confident that just because there's an election that the economy is going to all of a sudden be doing well.
Yeah.
Even if the Fed decided to, turn around and reduce rates, if you saw that chart that Josh had posted a while back, it's that chart showed you that when they finally did start to lower the rates, that's when the market took a hit.
Yeah.
Right.
And and not only that, but the inflation, like you said, the inflation will start heading right back up north. Right now, that's the only thing they have to fight inflation is those interest rates and trying to get people to stop spending, lower the demand, for goods and services, things like that. So I don't see how this administration can possibly make the economy magically appear, healthy. I mean, he's printing money like it's going out of style. That's counter to what the Fed is trying to accomplish. If he prints more money, it's going to just throw more gasoline on fire, as far as I can see. So I don't know. The only thing I can see him doing is if he opened up the pipelines, and started fracking and doing all that again. That's we have to work our way and earn our way into a better economy. You just can't print your way into it, and you just can't tax your way into it. And that's what these people want to do. That
I agree with you, Dan. But let me ask you, how likely do you think it is that the pipelines are opened up again, drilling, fracking? That'd be a pretty big reversal of policy at this point.
I'm sorry,
they're trying to take your gas stove away. Right?
Yeah. I think everyone agrees unlikely at this point, based off of how things are going, right?
Well, that's what I think, but I don't know. It's pretty muddy water.
Yeah, I don't think we're gonna have a choice but to start fracking and drilling and, do everything that we can. Because I don't know if you've seen the alignment of the BRICS, Russia, China, India, Saudi Arabia, Iran. They're buying oil now on the Chinese yuan. And they have those countries I just mentioned contain over half the world's population. So, and they're trying to push us off the pedestal for our reserve currency, and pray that doesn't happen in our lifetime or our kids' lifetime. But I think that's, a definite big headwind to our, having an economy that we could call healthy, So
Right.
we need to, we need to be more competitive, and energy is that competitive edge. And I don't mean solar energy. We already saw in Texas that doesn't work. I think nuclear and fracking and getting more oil out of the ground so that we can be a net exporter instead of an import. We're buying oil now. It's like,
I know. It's crazy.
and we're selling our reserves to China, which just blows my mind. But it's crazy. It's just crazy.
And the wind energy is killing all the whales.
Yeah.
Well, to that point, it just speaks to the enormous, and it's kind of always been this way, but the enormous importance of the party in power, and over the last couple decades, less and less similar-minded approaches, and each and every one of these elections, I think, just comes with a much heavier weight because of these critically important decisions that you laid out really well, Dan, in terms of us, self-sustaining going forward. So it'll be interesting, but difficult, I think.
Yeah, definitely difficult. Been talking that they're between a rock and a hard place, so I don't see an easy way out of it, personally. All right. Thanks, Lee. Dan, appreciate it. Anyone else, or we'd let Joe go? Yeah, we didn't, we had our first earnings trade. That's Travelers. I think it's down a little bit. That's the first pre-runner that came through. So they're just starting, so you can check the earnings plan. We had a couple come out today, but they're both estimated. So, but they'll start picking up here. So, all right. Well, I'll turn it over to you, Joe.
All right, Josh. Excuse me. I'll just grab the screen if I can for a minute. Just a couple charts, and to your point, I think essentially trading range still in force. Obviously, the RUT is, the one that has been the most, under the most pressure. Let me pull up these charts. Where the hell are they? There we go. So yeah, trading ranges. Let's see the few charts I have. Russell, basically, let me get this stuff out of here. Talked about that with you a little bit earlier, Josh. Just, the potential 5-wave down. It'd be interesting to see whether this 1689 level can hold. And, basically, it's either a 1, this is the 3. The question is, was this right in here the 4 and this the 5? Or is this the 4, as I said, inside of a 3 leg, inside of the 3rd leg? And that's where, this, if this was leg 1, this was leg 2, and then you get into leg 3, 1, 2, 3, 4, 5, ending leg 3, we go sideways for a while, and 4, then you get the last leg 5 down. Remains to be seen. It could go either way. That's why this 1689 level, I think, is going to be important, as you said. And the other thing about the kind of mixed messaging, with regards to states, a couple of the indexes are bearish. One of them has had a stop loss. One's bullish. So it really is kind of mixed messaging, if is my takeaway on this. Actually, let me and just in terms of the days, we've still got over 3 weeks if the time in the Russell is to hold. So we shall see. Something I think we mentioned before we haven't had a chance to do yet. Our analysis on time is over the 15 years of the database. So we've had 25 occurrences in state 8. This gives you the average number of days. What we'd like to do when we get a chance is just reduce maybe the period. Maybe we take a percentage of, the number of occurrences or a shorter period of time to see whether the average amount of time in the various states has changed over, say, the last 3, 4, or 5 years versus 15. So that's an analysis we'll do, when we get a chance down the road a little bit, just to see if, there are any insights in a shorter term analysis of time versus the 15 years. SPX, Josh covered it well. As I've said last couple of weeks, really in the face of what we're seeing, in the financials, I think the markets have really held up, awful well. And I think that's demonstrated in the SPX chart here. NDX has been leadership out of the October 13 lows, and especially since the first of the year. Where are we in the NDX state 5? The one bullish state, it did, a little bit of a short-term higher, but basically we're just hanging around the highs here in NDX. So, be interesting to see, what the future holds here. A little bit of a very, I guess, really insignificant divergence where, NDX basically had been leading. I think the last couple of days, maybe you got SPX to the upside, just marginally with, NDX to the downside. I think you're seeing the same thing today. SPX kind of flat and, pretty good sell-off in NDX. So we'll see if that changes. Obviously, with the banks, here's XLF. And just in terms of the ETFs, if we, look at the last month, basically we started, at our March 1st meeting, we had 4 of the 11 sectors in bullish states, 7 and 11. As we moved to the middle of the month, where we came under pressure with all the bank news, the 11 sectors went to 1 bullish only, which was XLK technology, kind of pairing with that NDX leadership, and 10 in a bearish state over the last 2 weeks. Obviously, we didn't meet last week. That's only moved a little bit. We've got 2 bullish states now, 9 bearish states. 6 of those 9 bearish states are state 8s. So, and XLK still being, the 1 bullish state. So we will continue to monitor this. XLF, again, if you start it, in the February highs, here we go. Leg 1 down, boom, boom, boom. Here's 2. There's your drop into leg 3. I think, again, it's very important to keep an eye on XLF in the short term. It really goes without saying with the banks being in the news the way they are. But is this recent low the end of the downward move, or is it essentially leg 4 inside, with another leg 5 to come to the downside? So, they're really, I think from a market perspective, a couple, important things to watch. XLK, it's, again, the one issue you know, in the XLFs with, you know, or in the ETFs with a state one, you know, just kind of slogging along here. No real downside movement in this at this point. Kind of a trading range with higher highs. You know, and then just a couple of the others that we've talked about over the last month. The industrials, you know, have begun to leak a little bit, but you know, nothing significant at this point. But for a while, they had been leadership and, you know, started to leak. And maybe that's, you know, a hint that some people believe that, you know, some of the earnings from the big boys maybe are going to, you know, have to be reduced. We shall see. I haven't seen any big earnings revisions. You know, Josh talked about, I think, growth, you know, GDP. I think, you know, we're seeing some revisions in GDP growth, but TBD there. XLY still in state 8, trying to, you know, fight that off a little bit. And then lastly, just the XLP, you know, another trading range. So not kind of surprisingly, we've got trading ranges in a market that I think is just currently range bound with mixed messages. Let's see. Anything else I wanted to touch on? I think just a couple things, you know, with regards to the XLF. You know, keeping an eye on whether that 5 wave is completed or, you know, just the beginning of a leg 4. I think worth watching. But the makeup of XLF, Berkshire Hathaway, you know, 14%, JP Morgan, 11%, Visa, 8%, MasterCard, 7%, and BAC at 5%. All the rest are below 3, just, you know, to offer a little bit of, you know, what makes up that thing. So rather than just a complete high-level gloss. I think that's it, Josh, in terms of the charts I just want to talk about. Interesting times, interesting market for sure. So
Yeah,
happy to
definitely, for
talk
sure.
about anything. If anybody's got any comments or questions, Josh and I, as he said, will be on the road up at a university conference in New York the next few days.
Yeah, anyone else? Got questions, comments before we wrap it up? All right, well, we'll close it up next week. Yeah, we'll resume the normal Wednesday meeting. So thank you all. We'll see you next week.
Thanks, everybody.